Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm Tracey Reineck, your host again this week, and I'm joined by Brian Bolin, Zach's equity strategist and the editor of Game Changers and Stocks Under 10 newsletters. And he's here to help us investigate Jack Dorsey and whether or not he can actually pull off this feat he's trying to accomplish of being the first CEO of possibly two successful, maybe profitable technology companies at the exact same time. And those two companies, of course, if you don't know, are Twitter and Square. And Brian, when they appointed him, he was running Square, and then they reappointed him as CEO last October back to Twitter because they were in chaos. And I thought it was nuts. I thought there's no way someone can do both. I thought it was breach of fiduciary duty by the board, to be honest, because who can run two companies? Square wasn't yet public. They were about to go public. I thought that was nuts. You're taking this other company public. You're trying to rescue, basically, this other one. But here we are, months later. Both companies just recently reported, including Square's very first report, and maybe it wasn't nuts.
It's kind of like a hindsight's 2020, when you think about it. The distraction of, having another company go IPO when you're trying to, get Twitter to resurrect itself.
Right.
Is a daunting task. And Jack was involved, obviously, in the founding of Twitter. I read that book, The Hatching Twitter by Nick Bilton, which gave an outstanding, picture of how things really came about. Between the four co-founders and, the one guy that kind of really started it, but kind of got pushed out altogether. And you really see how they all kind of ended up stabbing each other in the back to become CEO, time after time after time. And this is really kind of like Jack's second go round here as kind of the big boss at Twitter. And the question is, if he wasn't good enough the first time, why is he good enough the second?
Right.
And then at the same time, running two companies at once, kind of the basic idea here when we talk about Square is like, who can really do this? Who can run two companies at once? When you think of Steve Jobs and Pixar, Pixar.
He wasn't like running
Apple.
Pixar, really.
Right.
He was running Apple, really, and he owned part of Pixar.
And you've heard of these times where there's been the, co-CEOs, two people running one company, and here you've got one person running two. So,
right.
Think about the times where the two heads butting to try to get one thing done, as opposed to splitting your head in two and trying to get two things done.
Right.
Can
you even imagine what his scheduler must have to do? Like, you have these meetings for Twitter. Maybe he does like half the day is Twitter in the morning, half in the afternoon is Square. Like, how would you even do it?
Yeah, I was trying to come up with like a tagline of this, and it's kind of breaks down to the idea, if you want me to do two jobs somewhat well, I will, but I can't do one job really well by doing two jobs at once.
Right.
And that's kind of like the end idea here. You can't, make yourself the be all and end all for all things just because hey, I could be part of the team that founded Twitter, which is, a great and monumental technological development.
Right.
In the world of real time, there's nothing that really competes with Twitter. It's just who needs real time, and has that need, have they been able to grow that need outside of the people that already use it?
Yeah, let's talk about Twitter. We'll start off with them because I think they're interesting. In full disclosure, I did just recently buy some shares of Twitter because I felt like they fell too low. I know I get mocked about this, but I am one of their active users. But we were just talking before we went on the air here with Danny, who's here helping us do this podcast, and he's a millennial and he's not even on Twitter. And this seems to be their problem. I know in the recent report, for the fourth quarter, they said their total active monthly users were 307 million, but in the third quarter, they were 305 million. So basically, they flatlined in user growth so far, and that's not a good thing. Nobody wanted to see that because that's one of the keys that they need in order to keep growing revenue. It's one of the three keys. And so then when you hear, we're talking here with Danny, and he's not on it, how do they grow that base? Is it possible, or do they need another model because they're doing okay on the revenue side on the advertising. They have 130,000 advertisers now.
They're going to have to continue to grow advertisers. That's kind of a basic thing there. But then, it's kind of the use. At what point does the user experience get, sacrificed for revenue growth? When you don't have the user growth, the revenue growth is going to come from more ads. And that's going to detract from the user experience, which could push people away. And once you start seeing, the active users declining, that's when there's really going to be, the real fallout happens. I mean, it's tough when you see a stock that was, when I bought it, $51, and then sold it, maybe for 40. I don't even remember. It was painful back then too. But there wasn't even the slow of growth there, okay, or the the actual contraction. When that contraction happens, or if I'm thinking more like when. Then you're going to see that big, destruction of value, because that's when you have growth investors and value investors come in and take a look at this. The growth are going to be leaving and the value are going to be coming in. I like to say that there's at least a 75% change in the price of the stock between where a growth investor exits and a value investor enters. That's why I like to see the style scores that are come up on our Zach's homepage.
Yeah.
I like to see that big difference, an A in growth and an F or a D in value, because I'm more growth oriented. I look for that sort of thing, and I think that there needs to be that discrepancy. So when you're talking about Twitter and its prospects, I'm thinking more about is there going to be that growth type situation there for them, or is there not going to be growth? And revenue growth is one thing, but you got to have the user growth to really keep the wheels moving.
Yeah, on the revenue side, I was surprised by this. They're expected to grow revenue about 32% this year, which is pretty good, and that's above some of their peers. I looked at a list of those. LinkedIn is expected to grow at 25%. TripAdvisor, which is basically, the travel site, but also very user-oriented, is only expected to grow at 11%. Facebook is, of course, the leader, and they're expected to grow 47%. But 32% didn't sound too bad for me, given all the doom and gloom.
It's still a good growth number, and again, it's talking about the revenue idea, growing advertisers, ruining the user experience by, putting more ads in there. I've noticed that when you go to look at someone's individual tweet on the website or through other platforms, you're funneled to another site with, the site of the tweet and an ad.
Yeah.
So there's, obviously a lot more ads being shown. The potential for the pricing of those ads moving higher is also out there, but it's unlikely. So it's just the volume of ads is driving that, mechanism a little bit higher here. At some point, you can't drive it that much higher. And without the user growth, you're not really going to be able to grow the revenue in a meaningful way.
What do you think about changing the business model of Twitter away from kind of where it is all about the user growth to where there's this core group of heavy users? Like, I would say you and I might fit into that.
Sure.
We have thousands of tweets on there. There's certain people who tweet a lot and provide content and information, a lot of journalists. There's like these big events that happen on there. Like, I was just watching all the tweets last night when they had the Bachelor finale, all of that. There's certain people who, write about the Bachelor, journalists, and they, heavily followed on there. Is there a way that they could manage the business model so that, you enhance these people who are like the core content users versus just sheer numbers?
Yeah, I think that they've tried to move into that sort of thing, with the MoPub and the other things, trying to get Project Lightning, just trying to get more real time. Obviously, that's the space that they're, the key in, where Twitter, differentiates itself from Facebook, is that it's all about the live event. What's happening right now. I go to Twitter if I want to know. I search through
too.
Twitter. And figuring out a way that makes live events really happen right in front of you, as opposed to I got to find out what my friends think or what these other things think. That's kind of going to be where things happen down the road. Obviously their entry into video Vine was
that's been big.
pretty crazy when it first happened. And the Periscope,
Yeah.
that was another thing. But these things just haven't gotten the real traction where we're talking about them or using them, on a near daily basis. For the most part, Vine is kind of dead on the vine.
Yeah.
Because think of the last time that you looked at a vine that was out there.
I'm also thinking Periscope. We heard a lot about that when it first launched, and some people were starting to use it, but then that's kind of died off.
Right. And, there's a lot of worries like, oh, this is going to infringe on, the NFL or at the game. Who's going to, watch someone's.
Yeah, weren't they banning? They were banning some of that.
Right,
if you're at the game.
Who's going to watch someone's Periscope when it's on, CBS or Fox or, regular broadcast television? So
I don't know.
I mean, these are good tools, and that you feel like they're almost there. That there's just something missing, And if I was one of these tech gurus out there in venture capital land, I would probably try to push 2 or 3 of these other new ideas together to morph into something that's really going to change the game for them.
Now, do you think it was a mistake for Twitter to even go public? Because I liken it to Pinterest, which I like a lot. And that's the more women-focused, apparently, site that's not headquartered in Silicon Valley. So they've just gotten venture capital funding. They have a decent valuation, but nobody cares how many users they have or anything because they're not publicly traded. I know there was so much pressure on Twitter to go public, being in Silicon Valley, but was that just a mistake?
Yeah, the market really wanted it, and to say whether it's a mistake or not, I think it's too late. And, there's the rules of like, when you have to go public, when you have a certain number of investors after a certain amount of time, you have to go public. It's SEC rule, it's the thing that forced Google to. Google, pushed it out as long as it could. It waited for, every potential, way to stay private that they could. These things happen. Once you get the large number of investors, it's kind of an inevitability unless you're able to, creatively, manage those investors into, somebody's fund or something like that. But even when they tried to do that with Facebook and they said, all these clients for Goldman Sachs would be under, Goldman Sachs would be the actual entity that would own the ownership of the shares. But in essence, that wasn't the case, So I think, places like Pinterest will eventually be forced to if they get to that number of investors. And it becomes an issue of, how many insiders are going to be able to sell shares to continue to fund the company and also, open up new shares for, for expansion purposes.
Yeah, and I think Twitter probably was forced to because of its employee situation. Like the employees want to go public.
They need to have the liquidity. And,
and
I think that's one of the big problems there right now. It's, when you have the stock suffering and you see other parts of the market doing well, or at least.
How do you keep them? I guess that's been a rumor now too, that they're giving out extra options.
Extra shares. And, that dilutes the shareholder base. Wall Street doesn't like that. That hurts earnings, but it keeps the talent there. But then the question is, does the talent stay?
Right.
And if the talent feels like down the road, like, hey, this thing can go from 17 to 7, why would I care so much about 1,000 options?
Right. Right.
1,000 options, yes, that sounds great, to be, $17,000 or whatever it is. But then if it's $7,000 when I do actually get it, it doesn't really, doesn't make the mortgage payment.
Right, especially out there in Silicon Valley. Now, I looked at what the actual earnings are expected to do because they're still losing money, not bleeding it badly, but they are still losing. So in 2015, they lost 63 cents a share. In 2016, they're expected to lose 39 cents. And then by 2017, so far, the estimates are showing a loss of 17 cents. But they're going in the right direction. I see that as good news. So presumably by 2018, if these numbers keep holding up, they might be actually earning something by 2018.
It's kind of the internal optimism. The losses get smaller. There's another aspect to the losses getting smaller here is that as you issue more shares, you're gonna when you play with the denominator, you get that numerator moving. The equation tends to shift for you. So. Not that that's going to be that meaningful of an impact, or something that's really going to change. They're not going to double the number of shares and then end up cutting the per share loss in half.
Right.
But they're going to do a little bit of dilution in there, obviously, over
Yeah.
time with, more shares to more employees.
Okay, let's move on to Square because that one just reported. It was its first public report, and that was supposedly like the good report out of the two, although they didn't make any money either. But I saw revenues were up 49% to 374 million. But the losses did widen to 48 million from 37 million a year ago. They gave a little bit lighter guidance, I guess, for 2016. They saw revenues up about anywhere from 33 to 37% to 600 to 620 million. The thing that has some analysts a little bit nervous, I guess, is that the merchant base didn't really grow for the last 6 months. It's between 1.8 and 2 million, but they have this exciting Square Capital lending business that seems to be growing pretty fast. So is that where this company's heading, more into this lending, the small business lending?
Definitely that's going to have to be one of the avenues that they go down. Obviously, they've been around for a number of years,
Right.
so
They were
growing
the
their
leader
right,
kind of in this.
right, and that mobile payments thing, put the
Yeah.
dongle on top of your phone and swipe a credit
Right.
card. I loved it when it first came out, and it was a cool thing, and it brought all these micro-sized businesses into play where it's 1, 2, 3
Yeah.
people, something like that. Majority of it being one person. And when you can't end up growing that, you're going to have to look for other ways to grow the business. Obviously,
Right.
they did the email, pay through email, and electronic
Right.
payments those ways. Now, when you take a look at the peer-to-peer lending strategy, obviously that's been kind of hot here when we talk about
Yeah.
names like On Deck Capital
Right.
and Lending Club.
Those are their competitors.
Those are the competitors there. But there's literally dozens of
Right.
competitors just in
These
the
are the
payment
public
space.
ones.
Yeah, those are
Yeah.
right. So there's all sorts of those things. Everyone's trying to, make a dollar off the dollar they have, use the asset that they have to create, a small amount of return. And they don't understand the full amount of the risks involved with that,
Right.
and those become, a big thing, especially in a down market. You go into a down market, and
Right.
those loans are going to be the first ones that people will default on, and those places are whew, if the markets turn sour, those things are going to turn sour first and fast.
Okay. Speaking of that, I looked at some of their numbers, and Lending Club, they did loan originations were up 91% year over year for this last quarter. So that's super high. They gave pretty strong guidance for 2016 on the revenue side of 730 to 740 million. That was above consensus. They didn't see any credit deterioration yet. So not yet. So
Yep.
Nothing's going on in the credit thing. But they are less than 2% of all the loans, as you were just saying. There's so much opportunity in this sector because there's so many players. Nothing is consolidated. And then you have On Deck Capital. They're a little bit smaller. They did about 400 million. Well, they're about 400 million market cap. They didn't give as strong of 2016 guidance, but I did see that they don't see any loan deterioration yet either. And then you have Square Capital. This was interesting. In 2015, they did 400 million in loans. So they're a little bit smaller than Lending Club. They did it. They also gave 70,000 advances out to 50,000 customers. And that's the 50,000 out of the 2 million of their current customers. So you can see where they could grow as well if they keep giving loans out, these kind of small business loans. Some of it is to cover the advances and all that, we know we're getting this revenue in, but we have to cover the payroll. So that's where Square Capital comes in. This is an area that is great for the economy. It allows all these small businesses to avoid having to go to any big bank.
Right. And that's kind of when the first off idea when you look at these things, it's like, oh, it's great, and there's going to be more capital available, and that's going to push down rates, and that's going to make things wide open and help people. But the fact of the matter is that there's no regulation in this space, and the regulators are going to come down on them. And what if one day that the regulators just say, this peer-to-peer lending, it sounds great, but you know what?
Yeah.
It needs regulation. I mean, these things go poof and vanish.
Right.
And one other thing I wanted to bring up at the recent StockTwits meetup here in Chicago, that I was hosting, and I'm going to
Uh-oh.
guess this one was back in January. We had one guy that works actually in the tech department of Western Union,
Oh,
and then some other guy came in and was basically pitching the meeting, about his thing, his investment thing that he had, and it was, hey, work with me and put your capital into this lending club thing, and then we lend out the money, and it's basically like a bond. And
oh,
I told him, like, if there was a credit default swap on that, I would
right.
buy it because you don't know what you're getting
Right.
into at all. Like, what kind of
Wow.
loan quality you getting back? You have no clue.
This is kind of a sign. This is like the shoe shine boy or something. That makes
Kind
me
of,
nervous.
just when you have people out running around trying to scoop up people and get
Yeah.
them to invest in something that has no regulation,
Right.
and
Makes it sound so easy.
right, right. It's super sketch, super sketch.
Wow.
So, when you have the people running around doing that sort of thing, thankfully I was there to thwart some of that. I hope, I don't know. But I
Okay.
mean, there obviously the guy was talking. There are ways to make money in this, and there,
Yeah.
there's a potential that this might work. But just as the same, aspect that there's a potential that investing in any stock doesn't work.
Right.
Valiant, that could just happen
Right.
to anybody at any time.
Right. And that's a
You think
big cap
Valiant
company.
is as strong as could be with a
Yeah.
gigantic balance
Thousands
sheet
of
and
employees.
everything else,
Yeah.
1,000 employees, great,
Yeah.
working business model, and all of a sudden,
Right. Canadian.
yeah, they
No
could,
less.
yeah, right, they could suddenly they could default,
Right, right. Now, I did look at Square's earnings potential, and they're moving in the similar direction as Twitter, so this is good, but they are also not profitable yet. 2015, they saw a loss of $1.24. 2016, the analysts are expecting only a loss of 49 cents, so that's a pretty big jump right there.
Gigantic move, yeah.
Yeah, and then 2017, a loss of 26 cents. But again, you'd think maybe 2018, possibly 2019, they could be profitable, but who
Right,
knows?
when you start to look out, 2 and 3 and 4 years
Yeah.
out to where you think profitability is, there's a lot of things that can happen between now and then.
Yeah.
And obviously the landscape in the mobile payments will completely change
Right.
between 2016, 2019. It'll be completely different. I would think that we would, if we have 5% of the companies that are out there still in existence at that time. I think that would even be probably optimistic. Is Square one of them? Maybe, maybe not. Because it's publicly traded, it's
Yeah.
probably easier for it to get acquired. But again, you don't want to be buying a stock just for the hopes of it to be acquired.
So if you were a short-term investor, because it sounds like that's the time frame you're looking at, what do you think about these lending companies? We just mentioned 3 of them. They're all publicly traded here.
I like the idea in the near term,
Right, short.
because it is something that's interesting and it's growing, and there's buzz about it, and there's the loopholes haven't been closed up, and the regulation isn't fully there yet, and they haven't been fully vetted on that end. But over the long term, and I think we've seen J.P. Morgan even get into bed with the
Yeah.
lending club, or maybe on Deck Capital, or Chase with either one or both. That this is something that the big banks understand, and they know that it's out there and there's a potential for it, and it's very likely that they have an offering of it. I like to say that over time, the banks have always existed, and the third party processing the apps on the outside of the bank, they get the shine and the glimmer for a little bit, but over time, people trust the bank more than they trust that other third party, and the bank generally can acquire that third party when it makes most sense for them. So, when
Okay.
these things are beaten up, I think the banks come in and kind of pick up the scraps.
Okay, and what do you think about Twitter? Like short-term versus longer term? Do you like it at any term?
I think that it's got to find its value inside of that live event thing, and it
That
doesn't have the
niche.
right product, the right thing just yet for it. I mean, we use it every day, and
Yeah.
it's great, but
Not everybody does.
yeah, it needs to have that, and definitely when you have a CEO that's splitting his focus
Yeah.
on 2 separate publicly traded companies, you really you're up against the wall,
Right.
already
Right.
with your product and your thing. Why do you have management, shaving time off your schedule?
Right. How long of a time period does Jack Dorsey get? At least on the Twitter side. He still is going to be in Square, I believe. But how long do they give him to turn that around?
I mean, you got to figure that they're going to give him 2 years.
Okay.
You know,
and he was just put in October of 2015.
Right. So, I think, when you haven't even had a full year yet, and I think a lot of institutions look at it as you have to have a CEO with 1 full year under their belt to have a good understanding of how they're going to handle the cycles and the changes in the business. Do they give him that one? Once he gets that second year in, that's when the real kind of apples to apples comparison can take place, and that's where you really have to have seen something happen. So it's a full another year and a half basically for him.
Okay, so we'll give him some time.
Give him some time, but
we'll revisit it.
Right, it's something that changes on a daily basis almost for Twitter. Can they make that live thing happen? If they can and figure out a great way to monetize it, then sky's the limit.
Right.
But everything we've seen so far just really hasn't worked.
Okay. So if you're interested in any of these companies, let me give you the tickers. Square, SQ, Twitter, TWTR. On Deck Capital is ONDK, and Lending Club is LC. And we will check back in and see what else is going on with these. And as you know, you can always check out any of our articles on Zacks.com. Brian writes a lot about the tech area and the growth stocks in general, so you can check out his articles there. And you can also find us on our other podcasts on iTunes, of course, and on SoundCloud.com, and also on Zacks.com. I know we had a good podcast, Brian and I, in December 2015 on the top tech stocks for 2016. We might have to revisit that. I think some of them are doing pretty good, despite how the year started.
I know one blew up.
Okay.
Crash landed a little bit, so to
speak.
Speak.
1 out of 5. That's not so bad. We got a lot left in the year. It was for 2016.
Yeah,
it's just this is only a couple months out.
Yeah, we're only
so
one
we got
quarter
time.
in, and I'm pretty sure that LinkedIn is going to come back at some point.
Oh yeah,
and I guess the GoGo too.
Oh, the GoGo! I forgot that was on there. Yeah. Well, you never know. The Wi-Fi in the airplanes, that's still hot.
They've been interesting picks. We'll just leave it at that.
Okay.
Definitely.
All right.
It's the attention that they bring.
Right.
they're in the buzz. They're in the zone.
That's right. You
and make sure you follow Tracey on Twitter.
Well, yeah, both of us are on there.
Yeah, that's right.
So. We're under our names. Well, you're under B Bolin 1.
Yeah, because I'm the number one B
He's
Bolin.
The number one, the only one. And I'm under my name at Tracey Reineck. We're both also on StockTwits. So you can meet us there. And if you're ever in Chicago when there's a StockTwits meetup, Brian definitely goes every month, right?
Yeah,
you go
just about every month.
Yeah, so you can go there and speak to him live. So for Tracey and Brian on this week's podcast, I'll see you the next time.